And most of you, I think, already met Roman, and you probably have seen either our introduction of this live or his videos at YouTube. And today we are going to talk about recession investing. There are going to be some graphs, and of course, there are going to be some English, but we warned you, it's English, no translation. You can ask questions in your native language, of course, and I'll translate them for Roman. Don't be scared of graphs because they are needed when we're talking about economy. And Roman, I'm going to pass the floor to you. Many people in Ukraine are very grateful that you came to us, and I am glad to see you here.
Thank you so much for inviting me, Lyubomir. That's really kind of you. And hello, everyone. I will try to keep it slow, so I'll try to keep it clear as well. So I think one of the things that everybody is thinking about right now is about growth. Now, as an investor, generally, when periods of growth are low, usually that has a big effect on returns. So during a period of recession, clearly some assets will underperform. They'll perform badly, they'll have small returns, and some assets do well. And usually it's equity which likes periods of strong growth, and it's bonds which like periods of weak growth. However, in 2022, what we've seen is very different because we've just exited a period when interest rates were pretty much zero for over a decade. And we've suddenly gone to a period of high inflation following the pandemic because supply chains were disrupted and demand increased after the pandemic, and that pushed up commodity prices. And of course, the situation in Ukraine has also had an impact on global commodity prices and supply chains. And maybe we can talk about that in the questions afterwards and what will happen once this situation ends. But let me just switch to a presentation I've got, which I actually had on YouTube, but let me just tailor it for your interests, I hope. Let me just switch to sharing, and we should be able to see this.
Yeah, okay. Try to share it, and I'll allow.
Here we go.
Here you go. Yep.
Brilliant. So this is what I'm going to try and start with is how the returns that you receive from buying various different types of asset change during a recession. So you can see that during a period of recession, the returns that you receive for the S&P 500, if you have a non-recessionary period, so a period of growth, the returns are generally above zero. So you have higher returns. Sometimes you have negative returns, even during a period of growth, of course. But the typical return, that's this horizontal black bar, is positive during a period of growth in the US. But when there's a US recession, you can see that the typical return is below the dashed red line. That means the returns are now negative, and there's a big negative tail. Now, your portfolio will lose money during these periods of large negative returns. So this is why recession matters, because for equity, generally you get bigger negative returns when there's a period of recession. So this is why everyone's kind of obsessed with whether the US is about to enter a recession. And it's not just the US that matters. This is the same two pictures, so the same two periods. Green is when there's a US growth period. Pink is when there's a period of recession in the US. And these are all the different asset types. So gold, Chinese equity, UK equity, Japanese equity, US equity, German equity, French equity, the Hang Seng Index, which is Chinese equity, and of course oil. Now notice how as we go from safe assets like gold actually does better typically during a recession than it does during a period of growth. And for almost every other asset, the returns during a period of recession are worse. So the pink bar is below the green bar. But for gold, it's the other way around. And if we did the same thing for US Treasuries, we'd also find that in a recession, it performs better than in a period of growth. So that's what's really different about safe assets like gold and treasuries and risky assets like equity and commodities like oil. The recession means that risky assets perform worse. And really, a US recession affects assets all over the world. So this is why people are kind of obsessed with the US rather than any other country, because it affects returns in every asset class in every country. So really, things like oil, for example, are the ones is an asset which hugely varies according to US recession and growth. So you can see in a period of growth, oil does much better than during a period of recession. And that's just because demand for oil goes up during a period of growth and it falls during a period of recession. Now, if we look across different ETFs, so this is how you could actually invest in some of those asset classes, you can again see this huge difference between a recession period and a period of growth. So gilts, which are UK government bonds, actually perform better during a recession than they do during a period of growth. So the way to think of this is bonds, government bonds, feed off economic misery. Equity feeds off economic joy. And that's why if you have a combination of equity and bonds, your portfolio is diversified and it can weather these economic storms usually. So this is just the same information, but expressed as return distributions. I won't deal with that. And we can switch to government bonds. Now you can see that this is the yield on government bonds going back in the US, going back to just before, well, the end of the 1970s. And the general trend is falling yield. And that's true whether you look at the long end of the curve, so the 30-year rate, that's in red, or whether you look at the short end of the curve, that's in blue. So if the US government borrows for 1 year, the rate it pays to borrow is in blue. And if it borrows for 30 years, the line is shown in red. Now, you can see that the trend has been downwards, but this is really the turning point in 2022 when the trend seems to be reversing. So instead of a falling interest rate environment, we may be about to enter a long-term rising interest rate environment. And that's bad for bonds. And in fact, bonds at the long end of the curve have lost more than they've ever lost since the US Civil War. So that's over 120 years. So this has been an atrocious period for bonds because of this reversal of monetary policy. So we may be about to see bonds now start to recover from that terrible sell-off. So the question now is, as we've seen how important US recession is, what's the probability of a US recession? Well, if you actually look at the numbers, the latest GDP numbers from the US were for Q1 of this year, the first quarter of this year, and growth was okay. It was 3.5%. There was a big fall during the pandemic, a big bounce back after the pandemic, and now it's kind of gone back to pretty good growth levels. And if we look at US unemployment, so this is the percentage of people who are looking for work who aren't in work, the unemployment rate in the United States is very, very low. You'd have to look all the way back to before 1980 to see levels of unemployment so low. So certainly at the moment, the US is a long way from recession. It's nowhere near a recession. Growth is still pretty good and unemployment is very low. So there's really very little data that we can see right now that shows that the US is in trouble economically. Their growth looks pretty good. However, if we look at something like GDP now, well, what this does is it looks in real time at the latest economic indicators And what it does is to feed this into a model which forecasts growth for the second quarter of this year. And gradually that's been trending downwards. So this forecast for Q2, the second quarter of 2022, has been getting worse and worse. And since I made this graph, it's now gone to minus 1.9. So it'd be here really below where the graph is indicating here. So certainly when we look forwards, the picture is much less attractive. And it's way away from where the Fed is saying that growth is going to be. The Federal Reserve, the US central bank, expects that in 2023, growth will be around 2.2%, and in 2024, 2%. So certainly not a recession, but markets are telling us that that's looking more likely. Now, recently, the Federal Reserve has published a predictive model which looks at 1 year ahead and tries to forecast the probability of recession in the next year. And what was pretty shocking was this is actually forecasting a probability of more than 50%. And so this is certainly a worry for people who invest, because if we do see a recession, as we've already seen, that'll be a worse outlook for US equity and equity globally. And if we put in the latest numbers into this model, this is the probability of recession over time in blue, and the shaded blue regions are when we actually have a US recession. Now notice that when this model goes above about 0.7 probability, there's almost always a US recession. It picked up the one in 1970, the one in 1975, the one in 1980, and it was a little bit early with the one in 1990, but it got there in the end. And it also picked up the one in 2000, 2008, and currently it's also spiking. So it's very likely, if this model's correct, as it has been in the past, it's very likely that we will see a US recession. Now, these are the things which feed into the model. Weirdly, unemployment, when unemployment is low, that actually increases the probability of a US recession, because the only way to go for unemployment is up. So notice how when there are these low periods of unemployment, obviously they end often in a recession. So here it happened in 1970, happened again here. So a low in unemployment actually increases that probability. If inflation's high, as it is now, that increases the probability of recession. And of course, inflation is now very high. And if the US yield curve is inverted, that means the borrowing cost for a short period of time is greater than the borrowing cost for a long period of time, which is very unusual. That's also a sign of recession. And the US curve has been inverting recently. So that is also indicating we're going to get a recession. And then finally, if we look at credit spreads, so this is the riskiness of corporate bonds in the US and the probability of US companies going bust, which is what effectively this spread measures, that's also been increasing recently. And so that's also suggesting that we could get a US recession. So we've got a bad signal, a reasonable signal. You know, the yield curve wasn't too inverted, but it's got more inverted since I made this graph. So this has also gone thumbs down. And credit spreads weren't too high, but they're actually getting worse since I made this graph. So really, the US recession probability has increased a lot, and many of the indicators are pointing towards that now. So I guess it's less relevant to you guys in Ukraine, whether we're going to get a UK recession, but generally UK growth has been quite weak. And after the pandemic, it's actually risen a bit since I made the graph, but still it seems to be leveling off after we got the bounce back following the pandemic. So even in the UK, people are pricing in roughly 2 quarters of growth at the end of this, of 2 quarters of recession at the end of this year. Even the Bank of England is forecasting very weak growth for the next 3 or 4 years over the medium term. and also that goes with high inflation. So in summary then, we can't see US recession in the hard data yet, but some of these models that we look at are forecasting an increasing probability of recession. And if that does happen, then risky assets, so things like equity, corporate bonds, cryptocurrency, all of those asset types would underperform and probably have negative returns. So really, the kind of investments which would be safe in that kind of environment would be things like gold, cash, and developed market government bonds. Because now those have sold off, I think there's more leeway for yields to fall and for them to provide some degree of protection. So there we go. That's my take on recession at the moment and on asset types generally.
It looks scary because this model on forecast and recession, it goes up. It's very close to 0.7, I think you said.
Yeah, it's above 70% now.
It's above already. I have an interesting question for you. In fact, it's about UK market. I've seen UK equities underperform the other developed markets after the Brexit, and some analysts say that maybe UK market is kind of value market because it was not growing so much as US because it has all these financials and commodities companies. So is UK market something different? Can you consider it like a value, more safe compared to other markets?
What's weird about the UK, and the reason why it's done well this year and badly over the last 10 years, is its composition. So if we look at the industry breakdown for the UK, it has almost no tech, almost nothing. And if we look at what's done best in the United States, of course, it's Facebook, Apple, Microsoft, Google, all of the kind of big tech companies are what essentially has made the US perform really well and what made the UK underperform. However, since the beginning of this year, the style of investing which has performed best has been high income. In other words, stocks that pay a high dividend. And that's the UK's party trick. If you look at UK stocks, they're all being milked dry by their shareholders by paying out very high dividends. So that's our party trick. And this year it's worked very well. So the UK has sold off very little so far this year. And that's also an indirect version of value. Now, value investing is when you buy cheap stocks rather than growth stocks. And value has worked also very well this year. So that combination, but also the sector composition, which you mentioned, is very important. Lots of commodity exporters, a lot of pharmaceutical companies, and a lot of revenue generated outside the UK. So in a sense, things like the FTSE 100 are in a kind of perfect position to weather this storm at the beginning of 2022. However, looking forwards over the next 2 years, 5 years, 10 years, I think it'll be much more difficult for the UK to outperform, because what I'd expect would be that tech will continue to do well because it's very profitable. And these companies have almost global monopolies. So I wouldn't be surprised if the UK goes back to its trend of underperformance. I'm not really kind of holding out for the UK outperforming for a long period of time.
It's very honest from UK resident. You obviously don't have this home country bias.
Well, in the UK, I think as an investor, you have to be. I think one of the biases that a lot of people have is to buy their domestic stocks. And I often see, if I look at people's investments, they buy lots of UK stocks because they're very familiar. Familiarity, you always buy what's familiar. And that's a problem because the UK market's only 4% of global markets. That's why, it's smaller than Apple, So if you look at all of the UK stocks put together, the market cap is smaller than Apple, which kind of puts it in perspective.
Yeah, if you look from this perspective, obviously you want to diversify. Dear viewers, I'd like to remind you that you can ask questions, but I do have prepared questions for Roman, and probably the most important for us in Ukraine. Like here, we all believe that not just war is going to over someday, but Ukraine is going to win. And you mentioned high inflation, supply chain distractions, commodity pricing. Lots of it comes actually from the war, because grain, oil, etc., they are directly related to Russia, and Ukraine as big exporters of that. So I guess my question is, when the war is over, besides some optimism for the people, what's the economic effect it's going to have for markets?
I think the outcome actually depends a lot on the nature of the peace. So let's imagine for a moment that, for a wonderful moment, that there's a regime change in Russia. Okay, so I know this is unlikely, but let's imagine for a moment that Putin loses power, and I mean, not necessarily a pro-Western government comes in, but a less anti-Western government with more rational actors. If that's the case, then it's very unlikely that sanctions would remain in place. So if sanctions are dropped, then immediately 12% of the oil supply comes back online. And if that happens, then commodity prices, but primarily oil and gas, would fall very sharply. Now, if you look across developed markets or even emerging markets, the biggest driver of inflation is energy. So suddenly we go from a situation in which we get 80% year-on-year increases in some components of inflation, like fuel oil, 40% increases in things like gasoline in the US. We go from that situation to one in which we get perhaps comparable falls in those components. So we go from an inflationary period to a disinflationary period. Now, the effect on asset classes would be huge. For example, bonds absolutely would love that, because the kryptonite for bonds is inflation. And if you take away the kryptonite, Superman's back in business. So for bonds, that would be amazing. For equity as well, I think it would be good, because one of the things which has made growth stocks fall hugely in 2022 is high inflation and the Federal Reserve having to increase interest rates hugely to fight inflation. If inflation comes down, well, the Fed can take its foot off the brake and we get better economic growth, and growth stocks would do very well. And growth is, remember, what's really sold off. So we could have a kind of renaissance in those growth stocks, which did so well after the pandemic. So, you know, that would be a very interesting investment style to look at in that kind of outcome. So that's, you know, that's the kind of slightly unlikely, but I think that would be a nice outcome. Perhaps more likely outcome is some kind of stalemate, where there's a kind of grudging peace, where, you know, lines are drawn on a map and there's a kind of détente for a while, and the shooting stops, but the people who are in power remain in power, and the hostility between the West and Russia remains in place. And I think this is more likely. Now, if that happens, then that means sanctions will probably remain in place for some time. And if that's the case, then we're just going to get a continuation of what we have now, largely, as long as the sanctions do remain in place. Perhaps some of the grain shipments would continue from Ukraine, and that would be very important for the Middle East and North Africa, where it feeds a lot of people, grain from Ukraine. But the oil supply problems will continue. So why that doesn't matter very much long term is that countries like Germany are getting alternative sources of gas, for example, from the US, and they're building liquefied natural gas ports so that they can substitute their Russian supply. So gradually over time, the sanctions will matter less and growth can recover in the West, and that'll be disinflationary. But it won't be a sudden fall in inflation as we would in that kind of regime change scenario. It would be a gradual reduction in inflation and a gradual reawakening of growth as an investment style, and also for bonds to gradually improve. So really, these are the same outcome, but in one of those scenarios, it happens very quickly. And in the second scenario, the détente scenario, it happens very gradually. But the end point would be very similar, which is a return to growth, good equity returns, growth as an investment style coming back into fashion, and commodity prices coming down, and bonds recovering. So I think that's the kind of two scenarios which I think are most likely.
Yeah, we hope so, and it's good that investors all over the world kind of supporting the peace. We hope it's gonna come sooner than later. One more question. I do have questions in the chat, but I have one more very important question for you, Roman. When we explain in our clients the asset allocation, we say, okay, this is 100% equity and it's risky. Look, it's gonna look at 2008, it was minus 50. You don't want that because you won't fall asleep. And this is we use its traditional classical 60 equity, 40 bonds, as many other advisors do. And we say, okay, look, like you said, bonds are good when there is a misery around, and equity is when the joy dominates. But this half of the 2022 is very different. If you look at the 60-40 portfolio, is minus 16%. I think it's worse since World War II. So how would you explain people what's going on? Is this 60-40 good anymore? Or what should they expect maybe to have less minus even with this 40% bonds?
Well, the first thing to say is the relationship between bonds and equity depends on inflation. So when inflation is very high, it's kryptonite for bonds, but it's also kryptonite for equity to some extent. So that's only true of very high inflation when equity suffers from inflation. Long term, equity can actually weather fairly high inflation, but when it's very high, it's bad for equity too. So very high inflation makes bonds sell off and it makes equity sell off. So the correlation is no longer negative. Bonds don't diversify equity when inflation is high. So that's why it's really important to understand that in this situation, while inflation is high, that diversification is broken. And there are other environments where that happens. For example, when the US occasionally threatens not to pay its debts, when there's a debt ceiling argument, again, people panic. They sell their treasuries, their US government bonds, and they sell their equity because they're scared. So that's another situation in which this negative correlation breaks down. So the whole ethos behind 60-40 is that diversification. But there are certain environments in which that's toxic and it doesn't work. High inflation is one of them. Debt ceiling is another one. And I'm sure there are others. But most of the time, over a long period of time, if inflation is reasonable and there's no threat of a debt ceiling, then bonds diversify equity. So you'll sleep better at night if you have 60% equity, 40% bonds, because the portfolio will crash less. However, risk is kind of weird because you have to think about the period of time you're investing for. And if you're a long-term investor, and here we're talking about 10 years, 20 years left to invest, what's risky is bonds, because bonds perform very poorly over the long term. relative to equity. In fact, you can be almost certain that bonds will underperform equity over that kind of period. So the risky investment over a long period of time is bonds, because equity on average beats them by about 4%, and it has done for about 120 years. So if you are investing for a long period of time, not putting money into equity is the risky approach. That's why it's really important to have that understanding of how long you're going to be investing for. And for a long investment horizon, equity makes a lot of sense. For a short investment horizon, then you want safe stuff. So if you're saving for a house deposit or to buy a car or some kind of short-term purchase in the next few years, then you'd be crazy to put money into equity because it could crash over that period of time. But equity becomes more predictable over long periods. So really it depends on your investment horizon. And 60-40 is not dead. And I think it'll be fine. I think returns may be lower than they were in the past, but I think the diversification thing is still going to work.
Yeah, thank you for reassuring us and our viewers on the 60-40 topic, because
lots of people have been saying it's dead. 60-40 is dead, but I think that's not true.
Okay, let's proceed with some questions. Due to markets climbing higher and recovering after recessions, just a thought to consider when investing or using DCA during bear markets and recessions. I guess DCA, for our viewers, it's a dollar cost averaging. It put in your investments regularly, say each month or each quarter. And I think Raman is asking, is there a better technique than DCA for these bear markets?
I think lots of people invest as they earn. So, for example, they'll, if you're 20 years old or 30 years old, you're earning money, maybe you've got a young family, and you're kind of putting some money aside for your family and for your retirement. So just the nature of the way you save is dollar cost averaging. What's the alternative? You'd hold money back from the market and not invest it. Perhaps you'd hold it in the form of cash. Well, we know that's going to underperform equity most of the time. So, most people are natural dollar cost averagers. So that's some of the people I speak to. Some other people get a windfall. So they sell a company, they inherit money, or, it could be one guy, he won the lottery. Okay, so he had a lot of money. But these people, very different, because there you really do have a choice. Do I drip feed into markets, or do I put everything in today? Now, the reason why people dollar cost average in that kind of scenario, one reason would be that you expect a crash in the markets in the near future. So if you put everything in today, you'll be kicking yourself because you'll make a big loss, temporary loss. And it is temporary because it will recover eventually. The other reason is because it's to minimize regret. So if you put just 10% of your money in today, 10% in next month, 10% the month after that, and there is a crash, then at least you won't have taken the hit. So that's the usual justification for dollar cost averaging. Unfortunately, most of us don't know when a crash is coming. So most of the time it's best not to dollar cost average. You put all the money in straight away. And there's research by Vanguard which shows that 2/3 of the time you're better off putting everything in one go. 1/3 of the time, just before a crash, that's when it's best to dollar cost average. But unfortunately, none of us knows when a crash is about to happen. So that's why most of the time it's best just to put the money in as soon as you can. But if you look at something like valuation, so you don't invest money when equity is expensive, and when equity gets cheap, you put all of the money you've saved in, that strategy doesn't work. I've tried back testing it because most of the time markets drift upwards. So valuation is a very poor timing indicator. So really it's very hard to know which to do, but mostly it's to overcome your own cognitive biases. That's why people dollar cost average. to avoid regret.
Okay, thank you. You always come to this simple answer that dollar cost averaging is good, and people just want to say, just want to hear when is the next crash.
Yeah. I mean, people often try to guess, but it's impossible to know.
Okay, Dimon asks, the recession in USA is global recession because USA is such an important economy. Is there any place to hide in emerging markets, for example, China?
That's interesting. A lot of people say that. I remember this was, a popular opinion a while back, that China had decoupled from the US, by which people mean if the US goes into recession, then China will provide a kind of safe haven for that kind of environment. However, I think that's very unlikely. I mean, the way I think of this is kind of like when you're a kid and you remember when your mother and father would argue, or maybe your father woke up one day and he was grumpy and he'd argue with your mother. And then some other days your mother would get grumpy and she'd argue with your father. And the whole house becomes depressed when that happens. So I think of the US as kind of like dad and China is kind of like mum. And if either of them gets unhappy, the household's going to be in trouble, right? So I don't think you can ignore either one. But I don't think that China is a safe haven, because if the US goes into a deep recession, you bet it's going to affect China, because there's so much invested money that comes into the global economy from the US, and the whole appetite for risk globally is driven by the US and increasingly by China. There was a time when you could kind of ignore China, it wasn't really relevant, but now it makes up so much of global growth and so much of supply chains, and now an increasing amount of global markets, that you can't ignore it. So I don't think that China is a safe haven, and it's very difficult to find a safe haven in emerging markets. I mean, the only place I can think of at the moment would be oil exporting countries like the United Arab Emirates, Qatar, fairly small emerging and frontier markets, which have done well because of energy prices. But again, that's very volatile and it could turn around very quickly. So no, I don't think
exactly.
I don't think there's an emerging market safe haven.
As they say, there is nowhere to hide. Okay, the next question is kind of simple, I believe. Pablo asks, he's a passive investor. He's using DCA, planning horizon 20 plus years. Any advice for me for the time of this session? I guess we could just say, go on, Pablo, for next 20 years. Maybe you have something to add.
No, I think the best thing you can do is invest for as long as you can. So what I'd say is stay healthy. And if you're young, it helps a lot. So when I speak to young people, it's great because they've got a whole investing horizon ahead of them. And the game, to win this game in investing, the way you win is not to have huge returns, it's to have reasonable returns for a long period of time. That's a much more likely success recipe in investment. Trying to shoot out the lights with 200% returns is just not likely to succeed because you have to take too much risk to achieve it. But that kind of steady approach to investing, where you invest as much as you can early on, because that's going to compound more over time, and then just invest as much as you can as soon as you can, and invest for as long as possible, is what I'd say. So the longer the time, the better. To stay healthy, then you'll be a longer investor.
Yeah, steakhouse is a good recommendation because we need some time to enjoy all this money that we saved in investment. Okay, and we have Roman from the first question, and he says that you showed only recession returns versus growth returns, but didn't show the forward-looking returns for the next years after recession. Yeah, I don't quite get the question. I guess he asks, but it's obvious that after the recession, returns are going to be better.
What usually happens is kind of interesting. If you plot US GDP going into a recession, or actually the S&P 500 going into a recession, the effect on equity return is very short-lived. Usually, so it's an upward trend for the S&P. There's a slight dimple, the kind of inversion during the recession, but very quickly it goes back to the usual rate of growth. So, if you invest in the period when valuations are lower, just as the recession's happening, well, clearly that'll improve your returns long term. But really, it's just a kind of interruption in equity growth. It's not a permanent destruction of equity growth. That's the way I look at it. So it's really an opportunity, if anything.
Yeah, it's hard to think this way, especially for the newcomers to the market. But in fact, it is. It's the opportunity to buy good businesses at a better price now. Okay, we ran out of question in chat, but I have one more question, like a bonus question for you about real estate. It seems you rarely mention this topic, but we know in UK it's a big topic. Many people invest. The prices are going up and up and up, and sometimes it seems they are not reasonable anymore. Is that the effect of this low interest rate environment, or there is something more to that?
Interesting, because I'm doing a video for this Saturday on real estate. In the US, but also in developed markets elsewhere. So if you look at Canada and Australia and the UK and the US, Canada and Australia are just going off the radar in terms of growth of property. And I've got some Canadian clients who just say it's gone absolutely crazy. And usually the measure of value for a house is price to income. So you look at the house price, you divide it by the average income in the area, and that gives you a multiple, which usually it comes back to over a long period of time. Now, currently, the price to income multiples in the US, in the UK, certainly in Canada and Australia, are way above where they were in 2006, just before the global financial crisis. So there's no question that property is hugely overvalued. And usually when that happens, just like with equity, if you buy in a very high market, it reduces your long-term return. And there will be a period of correction when valuations normalize. Now, why would that happen? Well, because interest rates are increasing, or because inflation's very high, and that takes money out of people's pockets, so they've got less money to service their mortgage. So I think this environment in which interest rates are increasing is a toxic one for property. And combined with the very high valuations, that suggests that the returns looking forward are not going to be very good. It won't necessarily mean a huge crash because there's limited supply and big demand, but still, it does reduce the long-term return. And there could be a period of negative growth even. But I don't think it'll be particularly severe due to the supply-demand imbalance, particularly in the UK, but also other places such as the US.
All right. Anyone who's watching us, you've heard that Roman made a video on real estate. So you need to subscribe to PENSIONCRAFT on YouTube, and that's the sure way to watch this video and other great videos on investing that Roman makes regularly. And I want to thank you for this session from myself, from Ukrainian people. I don't know what is your party in UK. We are all fans of Boris Johnson here, but hopefully the next one will be our friend too.
I'm sure they will. Anyway, thank you for having me, Lyubimir. That's really kind of you.
Yes, thank you, Roman. And everyone, please don't forget to like this video, share, comment it, and invite friends, and just Reminding again, subscribe to both channels.